Portfolio Builder members, welcome to your Friday evening update. It's been a wild week with lots of head fakes. You can see the stock market's going up and down and left and right. But if you're going into the weekend without downside protection or a large position in the TLT, I certainly feel bad for you. There's good reason to be scared that the SPY could open $5 or $10 lower if China updates its coronavirus confirmed case count, and by Monday we'd be alarmed if it was somewhere between 15,000 and 20,000 cases. In our portfolio, we have a lot of downside protection, but have remained long the SPY. So we did give up some profits that week, this week, trading the SPY. But again, we did end January with a profit in the SPY portfolio, while the S&P 500 is now officially down 0.5% since the start of the year. And where will it open February 3rd on Monday? Who knows? Now, if we go to our TLT position, which you can see has done very well this week, we've been enjoying some good profits on that. And I do think TLT is going to travel significantly higher until we do have a better grasp of what the coronavirus is, how to stop it, and what the true infection rate is in China and what it will be in other countries like the United States. Our gold position is barely making a dent in terms of pushing up from all the fear in the market. The first knee-jerk reaction was to buy bonds, and I guess the argument that GDX isn't going up so rapidly right now is that the Fed stopped expanding its balance sheet in January, and I believe this is due to the government being able to successfully sell its debt because there's been a big bid in the bond market and sovereign debt. So that's probably your best reason. In the long run, U.S. is spending so much, $1 trillion plus per year deficit. This money will have to come from somewhere, and it's either going to come from foreigners, which I think there will be a couple months of them wanting to buy our bonds due to the coronavirus locking down China. But in the long run, it's going to force America to print more dollars and to expand the money supply. And that's why we want to be long GDX. So when we do look at the big picture, you can see why it's doing really well, while our debt to GDP is over 100%. So our growth rate last year was 2.1%, but our debt to GDP was 106. So net, we're losing as a country 4%. In other words, we had to borrow $106 to make 102. And so net, we're losing $4, which again forces our central bank to print money to buy the U.S. debt to keep this business cycle continuing. Now in this chart we have the emerging markets ETF EEM, and it's been nosediving. And again, earlier in the year my expectation was emerging markets would go up and that the SPY would go up alongside it. But what we saw was the opposite. Emerging markets started to tank and the SPY was heading up, and this was right after we had this supposed trade deal. So we knew something was wrong, but we didn't know what on earth it was. So sure enough, something was gravely wrong in China, and my expectation is this could crash significantly lower. I'm sure the Chinese will do whatever they can to protect their stock market, as they really need to borrow money to keep all these companies running. But as far as our trade, we are set up to profit wildly down to 40, where we will most likely close this out on Tuesday, and then look at if we want to do another bearish bet. And most likely, we most certainly will want to continue betting down on all assets related to China. So their bond market will most likely start having to cut interest rates. Their printing presses will likely fire up at rapid pace to print new money. And I believe their stock market will be under severe pressure from people getting scared that, they've shut down a third of China. And now all the countries are starting to isolate China. They've been quarantining their own people, and now the world's starting to quarantine China. So that's not good for emerging markets, clearly. Now, the dollar index was a little odd today, selling off significantly. And I'll have to take that into consideration. Typically, if the dollar's weak, gold would go up and emerging markets should go up. But gold's been relatively flat. Bonds made a little bit of a move today, not a huge move relative to the SPY crash. So it makes you wonder, where's all the money flowing to? Because a lot has just rushed out of the SPY in the past week. In this chart, we have LQD, and again, if I were to become bearish on the SPY for a prolonged period of time, I would want to see LQD also selling off and staying sold off. The higher this is, the cheaper it is for Microsoft, Apple, Amazon, you name it, to borrow money for nearly free interest rates and turn around and buy their own stock. They burn these shares, which makes the earning per share look great, even though their revenues or their profit lines are not necessarily improving all that much. Their businesses can just remain stabilized, and as long as they can borrow money and burn away the shares, it makes the earnings per share go up, and thus the stock price fly higher. And so until this one tanks, our top stocks in the SPY at least would appear to be able to continue buying back their stocks. And unless the government stops creating so much debt, it's hard to believe that the GDP will really drop much in 2020. Now, of course, if we start shutting down all our trade and travel because of a pandemic, that changes the picture quickly, and I think LQD will pick that up relatively fast once they see a risk in getting paid their bonds back. So perhaps the junk bonds will sell off first and be the canary in the coal mine. Here's HYG, and it is certainly showing a lot of weakness relative to LQD. So that is, to me, probably the most alarming chart we can look at today to justify wanting to bet down on the S&P 500. Besides, of course, its price action today. But when we look at the bigger picture of how will the stock market rebound, well, we did see record-breaking profits from all our top companies this week. So it really hasn't hit the earnings of our top companies in any way, shape, or form last year. And it's hard to see how, at least so far, it could really dramatically hurt these top companies in the U.S., who are global by nature. And really, the companies held in this portfolio in HYG are going to be a lot less globalized and a lot more localized in American markets. So I wouldn't be surprised if this pops back up if the exponential growth of the confirmed cases does start to slow down next week, which I think, even if it's not the reality, will be the reported case next week, because China's stock market's going to open up, and I wouldn't believe they would continue to show data that suggested it was raveling out of control to hundreds of thousands of cases by next week. So we'll have to keep a close eye on that this weekend. If we do see those sort of numbers, then certainly equity markets are in trouble. Now in this chart, we're comparing the U.S. 30-year bond yield percentage change against the German bond 30-year. Germany is tied to the hip to China. Don't trust China. We do trust Germany to a greater degree. And in fact, they're the ones who told us that this virus can be spread before you have symptoms. So that's what we're trusting from that info, straight from the U.S. government's doctors who are in charge of containing health concerns such as this said to us today. So Germans' yields are crashing, and so are U.S.'s. The trend looks like that will continue into next week. That means you want to continue being long the TLT. Now in our options program, again, we have the luxury of betting up or down on each individual asset, even for short periods of time. Towards the end of this video, I will review how I'd play this with a buy and hold portfolio, because we do have to use the TLT as the put under the SPY. So you don't really have that luxury to be trying to guess the market in the same time frames that we are in our options program. Okay, what I have up here is our options program. Now we have 2 layers of service. One trades just the SPY Monday, Wednesday, Friday. It's a great way to get started with the program. And if we do look at the return on that portfolio, we were up a lot more this start of this week, guys, last Friday. And unfortunately, we had 3 losing bets. We still beat the S&P 500. S&P 500 lost 0.5% in January, and we picked up 1%. We were up as much as 3%. But on Monday, we bet bearishly. The market flew up from Apple's earnings. Wednesday, we went with a tight option caller long, lost. And then today, we went long a tight option caller. And so far, we're down. So unfortunate on that. But we did go long the TLT on Monday in the option program, as well as GDX. So that did deliver some profits. In the short emerging markets position, the previous week, remember, we were long. The put option gave us a nice a nice profit, but did not completely wipe out the pullback in the emerging markets, which again caught us off guard. We were seeing the SPY go up, but emerging markets sell off, which was an alarm bell. But I didn't know why on earth it was happening, and now we do know. So we're about flat on portfolio 2, emerging markets, although I suspect we'll realize some pretty large profits next week when the Chinese stock market opens. Probably low, but I do expect they will do everything they can to buy it. Precious metals is down 3% this month. Not worried about it. This is a portfolio that has high levels of volatility and has had the best return of all portfolios, period, that we trade. And you can just go through the returns. To a degree, they look a little outrageous sometimes. But again, it only represents 10% of our total portfolio. The bond portfolio finally ended its losing streak. We had a hot streak in 2019, only losing on 3 out of 12 months, or rather 4. And then we finally squeaked out a 0.1% win in January. I would be shocked if we don't get a healthy profit of at least 1%, maybe a few percent in February, as this coronavirus continues to create uncertainty in the markets and drive yields lower. So we'll be looking at the opportunity to start buying some puts to protect against volatility on the TLT. But right now, this is my highest conviction trade going into February. That and being short the Chinese stock market. But I do think they're going to try to support that. And remember, you got your Ray Dalios, your Stanley Druckenmillers. They're all owning huge positions in EEM. So they might be trying to buy the dip and protect those positions next week when their market opens. We'll just have to see how it all plays out. So that's how our portfolio looks. We've continued to deliver profits, only one losing month in 14 months. That's really hard to do, guys. So bravo to everyone who's followed the program and remained confident and trusted the system to do its job. I think we have some much easier profits to pick up in February, but we're not going to do it foolishly while taking on too much risk. Okay, so what I'm going to do now is flip to my buy and hold portfolio, which I'll be covering daily now so that people can start following that who either don't want to trade options or want something that's a little more passive and takes on more risk because, again, you don't have that downside protection. Buy and hold portfolio, guys, and it's simple. It's still 1-to-2 ratio of SPY TLT, and it also plays GDX with a 2-to-1 ratio, but you don't need lots of 100 anymore. The only change we made in this portfolio was to go short the emerging markets with the ETF Yang. Now, luckily, EEM and Yang are currently quite closely priced, so you'll still keep that same 2-to-1 ratio in Yang. And again, I do think we can hold on to a short Chinese position in Yang for probably most of February and maybe longer, depending on just how ugly this gets and how long they keep their country shut down. In general, though, I don't want to be short equities with the current peace we have geopolitically with China. So that was my base case going into 2020, but unfortunately, epidemic in China does change the picture. So this portfolio looks very strong. Obviously, it's had a little bit more volatility. It's really done nothing except hold the SPY and TLT and GDX for the entire period, and continues to do so into February despite this sell-off in the stock market today. And so again, we use the TLT as the put and vice versa. Now this works as long as the Fed has room to cut interest rates, where we can almost mindlessly be long those two assets in that same 2-to-1 ratio. Now, if things dramatically change between now and this weekend, and it looks like equities are going to crash, we have the ETF UVXY to potentially rotate into in equities portfolio 1. So that would replace SPY and allow us to bet down in the stock market. I'm not ready to do that just yet. On the same breath, we also can bet down on GDX by using the ETF Dust, and we can use the TTT to short the bond market. But right now, again, we're back to simply only changing one position, which is to be short emerging markets by being long the inverse ETF Yang. Okay, so that's how I'd be playing my buy and hold portfolio. Same strategy, a little less flexibility. And again, this is going to look really good in a bull market. In a bear market, if you do get a 50% plus crash, the TLT can't absorb all the losses. Most likely it won't. But we do have the ability, again, to at some point bet down and flip SPY to UVXY. Okay, guys, so let's go look at some news. Jeffrey Gundlach, the bond king, one of my favorites to listen to. It took less than 2 days for the bond market to nullify the Fed's "we're firmly on hold" message this week. Now a 90% chance of a 2020 cut. Next headline, coronavirus contains HIV insertions, stoking fears of artificially created bioweapon. Don't forget, we saw the Harvard professor arrested with some students he was working with, a lot of money from China. We got some notes about a facility in Canada sending over these specific strains of viruses to China, with their scientists being in Canada. And there was a level 4, the only supposed level 4 bio research facility in Wuhan, right where this all started. So who knows, but perhaps they accidentally let loose a bioweapon on their own people, and now it's spreading the world. Great. And this is some of the pictures coming out of China, and that's just brilliant. It's got the air tube up top. It's a hell of a face mask, and they still have their... so anyway, I got my masks and preparing just in case. The death count and confirmation count has to start growing from 1,000 a day currently to a couple thousand a day by Monday to a couple tens of thousands by next Friday for this to continue being the level of exponential growth we've seen over the past 2 weeks. And if we start seeing numbers like that, I think people are going to really flip out. So you'll want to be long the SPY and short equity markets if that does happen. So what did the government have to say? Well, first of all, risk is low to the United States, don't worry, but we're going to start blocking everybody from China to fly into America. The folks we do have are going to be under quarantine. The tests we have are not accurate. We have no idea if they work. Sometimes they do, sometimes they don't. Sometimes the results change over time. So we have no idea, was basically what they said. But don't worry, the risk is super low. And enjoy the Super Bowl, right? Meanwhile, the impeachment had rumored it might be over today. I haven't been able to catch up on that. I've heard that it will most likely extend to next week, Wednesday, and that they don't have the vote for witnesses, so we'll just see how that pans out. Mike Bloomberg has a huge headline being written up about him on the front page of Drudge, saying that he's spent $100 million running negative ads about Trump so far, and he's going to spend $1 billion. So he's just getting his ad campaign started here. Meanwhile, Bernie is on fire, and that's probably, if we get the coronavirus under control, will become the next risk that the market freaks out about and potentially keeps the TLT going up all year. So it's going to be hard to make a decision on if and when we might want to short the TLT, and again, keeping a close eye on this coronavirus. If it does do what I think, and the Chinese start to just print a couple thousand confirmed cases a day, because that's all they can actually get from their hospitals, it's going to make the exponential growth look like it's much less than it was in the past 2 weeks, and that could help temper markets. Millions could die. Bill Gates warned in 2018 that the world needs to prepare for pandemics like war. And boy, are they not reacting correctly to this. They should have been shutting down. If it's really as bad as it seems like it is, we should have been quarantining China off weeks ago. China should have been quarantining itself off back in December. And so it looks like we've got some greedy corporate capitalists trying to avoid not losing a dollar at the fate of potentially hundreds of thousands of lives. So we'll just have to see how this plays out. And I'll leave you with this spooky article. School district closes for 2 days after 600 students call in sick. This is in Ohio. And so they're closing down school for 2 days. Are people freaking out? Is the virus spreading in the United States? Who knows? Only time will tell. Okay, guys, thank you so much. Monday, we trade the SPY. We'll just see where the market opens. It could be at 250. It wouldn't matter for us because we're long the TLT. So we'll make a lot of money from that if that's the case. And our put option kicks in. So we had that 327, 324 option caller. Short the 327 call, long the 324 put. So we have nothing to worry about. That's the best part about our program is we keep your money safe. Thank you. Have a great weekend.